rock and roll.
All right.
Back in the studio.
Yeah, back in the studio. Excellent. Good to be back.
It is good to be back because they have my favorite drink in
Pellegrino.
the San Pellegrino.
San Pellegrino.
In the fridge in the upstairs.
This is a good place we're working in here.
We have a nice office space. Yeah, if you guys ever want to come hang out, come to Leesburg. Give us a heads up, though.
Give us a heads up. Lots of pubs and breweries and wineries and San Pellegrino cans.
All right, man. It's Halloween.
It's the Halloween show. Yeah, we made it through October.
We didn't dress up, though.
No, I know. I was thinking about that. But
somebody posted on the Book of Faces or Meta or whatever it's called now.
Oh, yeah.
And they were like, is it okay not to dress up? And I was like, man, I'm a grown-ass man. I don't dress up.
Right.
I don't dress up.
Right.
I don't wear costumes in the bedroom or
outside. Excellent.
Yeah.
Yeah, it's the Halloween show. I just figured I'd put something a little bit different up there.
There it is.
So, scary Halloween. All right. We made it through October. Barely. Market was mixed, but pretty strong this week. C Fund was definitely the winner, up 1.33%. S Fund was basically flat. I Fund basically flat. And the F Fund was up 0.5 point, which is a pretty big jump for the F Fund, but we'll see in the chart later. Not really too much to get too excited about. Not yet anyway. All right. So this week we've had a bunch of questions about Roth.
To Roth or not to Roth?
To Roth or not to Roth? That is the question.
I love it.
Yeah. So we'll talk about that a little bit. I did a bunch of kind of research on it this week, and really what I was looking at Roth IRA and versus traditional IRAs. And you know, in IRAs you have contribution limits and different rules and things like that. In TSP, Roth TSP is different from a Roth IRA. So there's different things to kind of focus on, and it doesn't have the same restrictions that Roth IRA does. So we'll talk about it a little bit. And we had one pretty specific question on Facebook that we'll kind of pick apart. And then we're going to do where we are in terms of the Elliott wave count, and then the short term, how high could this thing go before we see another, at least somewhat of a correction. Bonus chart is going to be plug. We did it a few weeks ago. I went back and bought some this week, and I'm going to show you why I bought it. And then the 2-year weekly charts. So we're going to look at the question first, and then we'll talk through basically I screenshotted a couple things off the TSP site because it was the most specific to us. Because like I said, Roth and traditional is different in TSP than it is in regular IRAs. So the question is, I have a question about contributions to both Roth and traditional. This person, the majority of his portfolio is in traditional TSP. Till about a year ago, he had contributed some to an outside Roth IRA, so outside of TSP. Figured out that it was better to kind of centralize everything. He stopped contributing to the Roth and started contributing that money into the Roth TSP. So now he's got two accounts, right? A traditional and a Roth TSP. And he has some questions in here about thinking about whether or not it's worth the tax-free ability to withdraw from a Roth versus the compounding effect of having everything in one account. So we'll kind of talk through that after we look at the basics. All right. So what it all comes down to really is how you withdraw the money and how much you need in your cash flow into your account to spend every payday. So in terms of TSP, everything stays the same. You get matching whether you're doing a Roth or traditional. One of the biggest differences in Roth versus traditional in an IRA is that you have an income limit for a Roth IRA. It's something like $180,000, 160, something like that, $1,000 limit. And if you make more than that, you're not eligible to contribute to a Roth IRA. But you don't have those restrictions with Roth TSP. So since you don't have some of those other kinds of front-end restrictions, in TSP, what it comes down to is, do I expect a higher or lower income tax rate in retirement, right? How much money do I need in my paycheck right now? The third one I don't think is so important. Will my choice of tax treatment affect how much income tax I need to pay? Because that's sort of encompassed in sort of in the second part of this question. But if we look at the first one first, because that's really the bottom line, what people talk about in terms of Roth versus traditional. Do I expect a higher or lower income tax rate in retirement? Usually that sort of conversation is about, do I expect income tax rate in general to be higher over time? And most people think, taxes don't usually go down, they usually go up. So if taxes are higher when you retire, then you're going to be paying more on withdrawals from a traditional TSP account. So the basic difference is, when you contribute to a Roth, you're contributing with after-tax dollars. When you contribute to a traditional, you're contributing pre-tax dollars. So the money that you contribute to TSP, you're not getting taxed on, right? If you make $100,000 a year and you put $10,000 into your traditional TSP, at the end of the year, you only get taxed on $90,000, right? So you are paying less taxes on an ongoing basis, which means, going to the second part of this thing, how much do you need in your paycheck right now? You have more money to spend, right? Mm-hmm. So you can either spend it or set it aside and, invest it in something else or whatever. So you have more money to spend ongoing in a traditional. So for me, I think the way I kind of think through it, if you are not maxing out TSP right now, then I'm not sure why you would do a Roth.
Right.
Because you need the money now, right? So if you need it to live on, or whatever your circumstances are, it doesn't make sense to if you need it now, based on your circumstances, you're not really worrying about later because you're not there yet, right? If you have plenty of money and you don't to live on now and stuff your circumstances, then if you contribute to a Roth, regardless of what the income tax rate is when you retire, anything that you withdraw from that Roth is tax-free, right? So that's awesome, really. It's great. If you don't have to worry about taking taxes out when you withdraw it, then it's great. But that's just kind of how I look at it. If you need, like, I never maxed out my TSP.
Yeah.
Because my circumstances didn't allow
for it. Yeah.
So
plenty of people helping you spend your money.
Yeah, they still are. So that was just my circumstances. But if you have plenty of disposable income, I think a Roth is probably the better way to go, on the expectation that the taxes will be higher in the future. The other part of that is what your circumstances will look like in retirement, right? Because you got your circumstances now while you're employed, but when you retire, are you, if you're single, your tax rate's going to be much higher, right, than it would be if you're married and you have all kinds of child deductions.
I think the
else.
narrative has changed now so much. We're still in this old narrative of, I get to my 50s or 60s, I retire, I go off and, we downsize and live in a small house, and we, all our expenses go down, and I'm not getting taxed because I don't have that much income. Like, that whole narrative that we're living in, like the 50s or 60s, is gone, right?
Yeah.
Everybody's circumstances when they're 50s and 60s and 70s is astronomically different now than it was when, like, our grandparents,
for sure.
more so our grandparents. And so I think that's where we have to kind of, like, scratch the record and, like, get out of that song, because it's like, no. We use that narrative to kind of talk our way into, like, oh, well, this is what my life will look like is it?
Right.
Is that what it'll look like? Do you really know? I mean, are you, because and we rarely talk about personal circumstances, right? Because the market doesn't care about your circumstances, right? So that's how we kind of look at the market. But when you're making decisions like this, right, Roth or traditional, tax implications, you do have to take your personal circumstances.
Absolutely.
Right? That's outside of the scope of what we do. In a sense, right? But I just think the biggest problem is the narrative. I think people still try to plan their retirement based off what their grandparents did.
Yeah.
When they're not really kind of, you got to be kind of self-reflection.
Reflecting.
Yeah, you have to reflect on, like, what do you think your life will look like? We don't know.
It's hard.
What your life is going to look like.
Right.
We know
my own life. Barely know what my own life is going to look like in 10 years, right?
I know. That's what I was saying. We're both in our 50s, and we have no idea what our life will look like in our 60s.
Right.
That's just 10 years from now. If you're in your 30s or 40s right now, contemplating retirement, my only point is, don't fall into this picture of what people tell you retirement will look like. Go talk to some retirees.
Yeah.
I don't know one retiree that their world looks the same as the other.
Right. True.
We all have friends right now that we're all retiring, right?
Yeah.
Retiring in quotation marks, right? 50s, you're not really retiring.
Well, right. You used to retire, right?
And it's funny. People look at me and I'm like, I'm retired, and they're like, what?
You're right.
What? You're 50 to what?
Right.
And I'm like, well, okay, I worked for the government and we get to retire. Right. But that doesn't mean I'm like dead.
No. It's I don't even call it retirement. I just changed jobs.
Yeah.
I mean, and actually this is kind of a good point, because if you
But
retire,
you get a pension every month, so that's
that's
no,
it's good. It helps. Yeah, it's retirement. Yeah, it certainly helps. It enables us to do this and not have to, but if you retire and you are at an age where you can, so 59 and a half is the age you can start withdrawing these things without an IRS penalty. So if you get to, say, 60 and you can start withdrawing or using some of this money to do other things with, if you only have retirement income and you're going to get taxed at the tax rate and all that, if that's your income, then whether or not you did a Roth, invested in a Roth versus traditional is going to make a difference. If you're living on, proceeds from rental income or dividends from a company, or you have if you get another job, then that's just added income. But if you start a company and you there's just so many other different things.
I mean, in our experience, I think most of the people we know that leave the government at retirement age do one of two things. They roll over into another job that's much like what they've been doing, right? So they go to contracting or something, right?
Majority.
A lot of our friends do that. Or they absolutely stop doing everything, right?
Yes,
they
pretty much one of the two.
They really retire.
Yeah.
And then there's the outliers like us that are like, well, we're not going to do either one of those. Like, I'm not going to work for somebody, and I'm not done doing things. Like, I want to do other things. I just don't want to do them for someone else, right? So, but I think that's probably a smaller slice of people that go on to kind of be entrepreneurs or, open their own business because they've been waiting for, 20 years to go do it. There are, we know people that do that, but I think by and large, at least from my experience, is people going. So my point is that your tax bracket didn't necessarily go down. As a matter of fact, most people I know roll out of the government and make more money.
Right.
Right.
Yeah, because then you are getting a pension and you're getting a salary from whatever you did. So yeah, if your tax rate goes up because you are making more money, then you're going to pay more taxes on the withdrawals that you take from your IRA. So, it's very personal, and there's definitely no right and wrong answer. And at the end of the day, at the end of the day, I think that if you're not contributing the maximum to TSP, there's no point in doing.
Yeah, why are you worried about Roth?
If you are, then you're only going to know in hindsight whether or not it was a good decision, and a good decision just means that you could have gotten over, right? I mean, if taxes go down, then hey, I would have done better if it was traditional, right?
And I'm just a big fan of pre-tax anything, right? HSAs, IRA, 401k, whatever. Right. If they're going to give you matching, take it.
Yep.
B, if it's pre-tax. If Uncle Sammy's not going to take some out before I put it in that bucket, I'm all for pre-tax anything, right? And so then I start thinking about anything that's like, okay, I can defer, I can pay the taxes now because they're low, and go. That's an afterthought to me, right? I go all in on pre-tax. That's just
my. So. I mean, I never. Roth came along later enough in my career that I didn't really think about if I was going to do the transition, because I definitely didn't want to pay the taxes and up front and
to dump it in.
Like, I'm not doing a Roth now,
right? Yeah, but it's not to say that it's not a good tool.
Sure.
It's just very personal. And that's why it drives me crazy when I see people in our group ask 15,000 other people, 14,000 some odd,
Yeah.
you know, what should I do?
Yeah.
I don't know. What's your life? What do you think? Like, what's going on in your world 20 years from now? Like, we don't know. Only you know.
Yeah. No.
So when you ask a bunch of, hooples like us,
Yeah,
whether you
what
should
to
go
do.
Roth or traditional, man, that's only a question you can answer.
Yeah. I mean, you have to understand the basics, which hopefully that's what we're talking through a little bit. But beyond understanding what the basics are.
Yeah, get educated and then make your choice.
Yeah.
Absolutely.
Okay. So that's kind of the distinction between the two of them. And really what you got to think about is our tax is going to be higher when you withdraw the money. And it's going to be based on both your circumstances and the tax rate at the time. And then the other thing we talked about is how much do you need in your paycheck right now? Because you're going to have less money in your paycheck if you go with the Roth option. Right. So some of the distinctions there, though, with the Roth, your contributions go into TSP, like we said, after tax withholding. So you pay the taxes first at whatever the rate is right now. The advantage of the Roth is that you won't have to pay taxes later when you withdraw your contributions and any qualified earnings. So withdrawals are considered qualified. This is kind of an important thing for the Roth. They're considered qualified after both of the IRS requirements are met. You get 5 years have passed since January 1st of the calendar year when you made your first Roth TSP contribution, so which basically means you're vested. And you are at least 59 and a half permanently disabled or deceased, which I don't even know why they put that in there. So if you expect your tax rate to be higher when you make withdrawals, Roth may be the better option. Yes, we talked about that. It certainly could be a better option. Traditional, your contributions go into TSP before tax withholdings. However, when you take money from your traditional, you pay taxes on both the contributions and the earnings at the income tax rate that you in the year that you make the withdrawals. So if you expect your tax rate to be lower when you make withdrawals, traditional TSP might be better. So like we said, if your circumstances, if you're gonna need less disposable income when you retire, then traditional is probably a better way to go. You just have to, make some assumptions about what your future is going to look like. Easier said than done. The third option is kind of a mix of both. So you can split it. You can have both a traditional and a Roth. The big thing for us, well, there's a couple things. The big thing for us really is that matching goes to your traditional. It doesn't go to your Roth. So that's something to keep in mind. The matching goes to the traditional side and not the Roth side of your account. But when you're making withdrawals, this was an example. It's on a percentage basis. They withdraw evenly from both your traditional and your Roth. Other than that, there's not really a whole lot of differences. When you make withdrawals from your account, you can choose to withdraw from traditional balances only, from your Roth balance only, or both proportionally. So let's go to the question and just kind of pick it apart a little bit. So he's got 99% of his TSP portfolio in traditional because he's been in the government for a while. Had been contributing some to an outside Roth IRA. Decided to stop the other Roth, started putting that money towards a TSP Roth. So now he's got a TSP Roth, which is just starting, and a traditional TSP. But with the compound interest effect I get on the traditional, I'm wondering if the tax-free element of the Roth is worth the lower amount in TSP. At the end of the day, I think it's going to be nickels and dimes, and it's really more about your personal circumstances, both now and in the future. If you have plenty of disposable income and you are maxing out TSP, I would do the Roth. That's a great option. And if you can contribute enough and grow the account enough so that half of your account is in Roth and half of it's in TSP, then when you go to withdraw, you're only paying taxes on the amount that maybe some years you withdraw from the Roth because you you don't want to have to worry about paying taxes on those things. Maybe you're going to go buy a house, right? And you withdraw when you retire from your Roth to put the down payment on the house. You don't have to pay taxes on that. And maybe you use as supplemental income that you're going to be paying the taxes on. You take $1,000 a month to live on from your traditional side.
Yeah, and there's a lot of maybes in there.
Oh yeah.
So I think the biggest thing is what most people, I think most people get confused between investment advice and tax advice.
Yeah, for sure.
Right. This is a question for your CPA.
Yep.
When I first read the question, I thought that go talk to an accountant.
For sure. Yeah.
Because what you do is you tell the accountant, right, your personal circumstances, your plan.
Yep.
Because that matters. Like we talk about how to grow your account, right? And we try to grow our account by being on
the right side of the market.
Yeah, being on the right side of the market. The market doesn't care what tax rate is,
right?
Right? And none of us know what the tax rate is going to be in 20 years, 15 years, 5 years, right? We want to blame it all on politics, but a lot of times it's just the world, right? Economics is happening. And so my only point there is that, like, we don't really worry about, I would say we make a lot of decisions to get to like most people do that, have any kind of income level, or I shouldn't say income. They have a resource level where they can live above like sustenance, right? What you do with that extra piece matters. And if you invest it instead of just spending it on something that's not investment, then what you start to think about is, what's my tax implications, right? So if you're in a position that you're worried about your taxes, then go talk to a tax expert. Because what you'll do is you'll try to do things like spend money pre-tax, right? Invest it pre-tax. That's what we were just talking about a second ago. Also, what you'll try to do is you'll try to find ways to shelter money, right? You'll put it in a rental property, like you mentioned a minute ago, right? Those are all tax implications, right? So go find a CPA.
Yeah. I mean,
sit down and tell them your story.
Yep, CPA and or to start with a fee-only financial planner.
That's where I was headed to.
Yeah, financial planner. Like, if you're our age and you go to a financial planner, you're wanting somebody to help you build a plan. You're not looking for somebody to sell you an ongoing subscription to somebody's mutual fund, and that's generally how planners make their money. So if you go to a fee-only planner, they'll help you create a plan, and hopefully you can stick with it.
Yeah, you'll pay them a flat rate.
Yeah.
And this is your plan.
Yeah.
And then you stick to your plan. Your plans change, go back to the person.
Right.
And they'll help you, change the plan.
For example, like if you were 5 years out from retirement and you had both a Roth and a traditional TSP, and you wanted to buy, a vacation home or whatever, put a down payment on that vacation home, obviously a good example would be you would take it from your Roth side, because if you take it from your traditional side, you're paying tax at whatever your income tax rate is that year on that money that you take out. So, if you want to go, I want to buy a house in Myrtle Beach in cash, awesome. If you have, you obviously have the money to do it. B, if you withdraw it from your Roth, you can just go buy that house in cash and you're not paying any taxes on it.
Yep.
So it's all personal circumstances.
Yep.
All right. So hopefully that answers some of that. Okay. Back to what we actually do. Trying to be on the right side of the market. So we put up this same chart last week, and I think where we are, here's the COVID low. We were talking about how 1, 2, 3, 4, 5, this is a 1, and we're good for that 1. This was the first correction, ABC. This is the first major correction that we had that came off this long run from the COVID low. So I think this 1 and 2 are probably good. Where it gets a little bit trickier is what the count looks like going forward. So the first idea was that this was going to be the 2, this was the 3, the September correction would be the 4, and we would get to a 5. But the September correction wasn't deep enough or long enough to really offset this 2. well, to offset the gain from this 3, but it wasn't commensurate with this 2. So I think a better count is that within the 3, so rather than this being 1, 2, 3, 4, 5, we're going to get a more extended 3. So we get 1, 2, 3, and this correction in September is probably a 4 of the 3, right? So that means this move that we're in higher right now, when it ends, that is likely to be the end of the main 3. So now we got 1, 2, 3, and then we have a longer term 4, and then we go to a longer term 5. And the Fibonacci extension level, the first one, the first one is 100%, which we got to easily back here. The 1.618 was somewhere around right here, and the 2.618 is 5367. So the extension is from the top of where we were before COVID down. So if you take this distance right here and you multiply it by 1.618, you get here. If you multiply it by 2.618, you get here at 5367. So this now is the target. Doesn't mean we're going to get there, but that's the target. So that's where this 5 ought to end. Before we get there, we got to get to the 3. Then we have some kind of correction for the 4, and then we go up to the 5. So right now we're looking at what's the 3 going to be, and how do we get there? Okay. This is where we're looking at the 3 to end. And this is the 1.618 Fibonacci projection of the September correction. So if you take the distance from the top of where we were at the beginning of September to the bottom on the 4th of October, this distance here, times 1.618, you get 4712. So that's what I'm saying the target is for this move that we're in to move higher. And when we get there, it will be this 3 right here. Okay. So this was last week. We put this chart up last week, and this is where we are now. So last week we had the ABC, and we were up this week. All right, this is where we were last week, and this is where we are now. So we're butting up against this resistance line. This area right here, it's interesting because the red day in the middle there was Wednesday, and if you looked at the chart that I put up earlier, it was a grid really, the seasonal grid, that big red down day that we had on Wednesday was supposed to be, historically, was the #1 day to be in the stock market for the year. So if you rolled the dice on the historical of that one day, you got killed. But in the bigger term, in terms of seasonality, November, the last week of October, beginning of November is usually very strong. And I'm actually putting out a seasonal chart in the newsletter this week, and we're going to talk through how to kind of use the seasonal grid, how it can be your bias for using technical analysis through different kind of seasons of the year. So yeah, if you pick that one day to load up, you kind of got killed. But so we're not 100%, I wouldn't say, above that resistance level right now, that trend line. But once we get above it, and I think we will, we go higher, and ideally we get up to this area right here to complete the 3. Once we get there, I don't think at this point we come down and test those lows, but we get some kind of correction like that and then move higher to the 5. All right, that's what I think it's going to look like. We'll see how it plays out.
We'll see how it does.
Okay, plug. We did this a while ago. I don't remember how long ago we did it, but where we are right now, you can see if you look, this is like the thing about technical analysis. If you can pick out areas of support and resistance. So Plug came up to about 35, churned around here for a little bit, and then gapped way higher and ran up to 75, right? It's kind of a meme stock. So ran up to 75, had a pretty good, you could call it a double top. You definitely get this consolidation in here. Once we broke that trend line, if you didn't get out there, obviously you took quite a hit. But so it comes down, does a pretty good bottoming pattern here on really low volume, right? Breaks out of that bottoming pattern on really big volume right there, right? Then gapped up and starts churning around again at around 35. So 35 is a pretty significant number in the chart. And so we broke out pretty good this week on a daily basis, right, on pretty high volume through that 35 number. So as long as we stay above 35, I'm happy to be in plug for a while, and we'll see what happens. I bought it at like, I don't know, 37-ish. And so we'll see what happens. It's got pretty good increasing volume, coming off of a consolidation with really low volume. So I think plug goes higher from here.
And again, these are, teaching tools, right? That's why we throw in a bonus chart so that we're not always talking about, TSP, because at some point those charts, start to glaze over.
Yeah.
And so Jerry throws these bonus charts in there to kind of give you some perspective on, how these rules play out in any investment, right?
Right. I mean, one of the big takeaways from this is the volatility, right? I mean, you got a plug down here at $20 this time last year, ran up to 75, and then all the way back down to 20, So it's not like trading TSP.
Yeah.
And again, the only reason we're doing this is to show how the same rules that you can learn from what we're doing here with TSP, you can use trading anything you want, right? The last thing I guess I wanted to throw in on this is this relative strength line down here. So if you're in stock charts and you go down and you set price as one of the parameters, and you can do the price of one stock versus another stock, or one index versus another index. So what I did here was plug versus the S&P 500. So what that tells you is when this line is moving down, right, because plug is in the numerator, it means plug is doing worse relative to the S&P 500. So now out here we can see plug is starting to do better, it's starting to outperform the S&P 500, right? So even though the C fund is doing really well in the last couple of months, right? So a good example. So September, the S&P 500 was down. Plug didn't go down. It went sideways through September. So the relative strength of plug was higher than the S&P during September, and it's increasing. So if you're going to buy a stock, you want to buy it obviously when the price of the stock is going up, but also when it's going up relative to the S&P 500. Okay. All right, on to the TSP charts. So on a weekly basis, you can see that the September correction we haven't seen anything like it since last September. Could we get another little kind of double bottom like we had? It won't be exactly the same because we didn't get to new highs on this one before we rolled over, and we're already at new highs now. So, and then this week, we went to new highs on bigger volume, increasing volume than we have on the last few weeks. You get all the indicators turning up. So on a weekly basis, no reason not to be in the C fund. S fund, we've been talking about it for a while. Hopefully the S fund is starting to break out of this long-term consolidation pattern. It's not there yet. It's not far enough along, but I'm looking at it pretty closely because right now I'm 100% C fund. I would be looking, if we do get a gap up out of the S fund, it should explode to the upside. And at that point, I would definitely reallocate some from C to S. But one of the things that you might have heard about people talking about that we've been in this sort of stealth correction for most of 2021, and you can kind of see it here. So the S fund represents more of a broader market than the S&P 500. There's basically 5,000 stocks. The S&P 500 is the biggest 500, but the remainder of them have gone basically flat for the year, and the MACD has been declining. So at some point when this crosses over, momentum should go up, and price should really go up. I'm just waiting for it to play out. I don't want to. It could roll over, but it looks really strong right now. iFund is in a similar kind of boat. I don't really like you have a lower high here, a higher high here. If the iFund was to roll over here, this would be a really good topping pattern. So I don't like the consolidation pattern in the iFund as much as the S fund. On the other hand, you got a pretty good double bottom here, so you don't have lower lows, which is a positive thing. So we'll see, and you also still have the MACD has been declining even while prices continue going higher. So if everything breaks out, it'll all break out together. You're not going to get a divergence where the I fund goes down significantly and the C fund goes up significantly. It's not going to work out that way. F fund had a big week, right? It was up 0.5% for the week. But zoom in there on the F fund. It hit the 50-day moving average line and pulled back. So it didn't close at the high for the week. You get the 10-day that looks like it's going to cross down again through the 50-day, which is not a very positive thing. And we've got 1, 2, 3, 4 weeks below that 50-week moving average line. So a lot of resistance to work through before the F fund gets back above into a place that I would buy it. And again, we only buy it if the stock funds don't look good, which the stock funds look much better than the F fund right now. Yeah. And so, I mean, some of the interest rates got some relief this week. So that's why the F fund price moved higher. But it's bumping up into a bunch of resistance. So we'll see.
Questions.
Lights out. Lights went out at the same time for questions. So yeah, you must be at the end.
Our TV went out.
Yeah, I guess that's it for us.
You got to turn it off. So if you guys liked what you hear, please share it with your friends. Hopefully you guys have a safe and happy Halloween.
Yep, it's gonna be a big
All
night.
the kiddies get some good candy. I'm gonna be taking my youngest. This is probably one of her last Halloweens. I think.
Yeah, she's getting there.
Yeah, but she's still in it for this one. So we're gonna go walking around the neighborhood one more time.
Very cool.
Yeah, it should be a lot of fun. All right, guys. Again, if you liked it, please share it with your friends. We've been doing a little push to get people to like our Facebook page. We have like 15,000 people in our Facebook group.
Yeah.
Not so many people liking the page. And the reason why we want you to like the page is because we're going to start putting out, more content on the page, and you'll miss it if you're not following it. So, you want to
Definitely
keep
follow
up with
the
your
page.
TSP stuff because there's a lot coming out here in the next few months. We were talking about it right before we started recording about this whole mutual fund thing.
Yeah.
There's going to be lots of stuff going on, and you don't want to miss it. Stay up to speed.
Absolutely.
All right. I hope you guys had a great weekend, and we will see you next week.
We're out.
We are out of here.
Yeah, there we go.
That's it.